Hello and welcome to M&A Murders and Accusations, the good, the bad, and the ugly of selling your business. We dig into what you need to know and how not to kill the sell of your business. Now here's our host, Rick J. Krebs, Mergers and Acquisitions Advisor.
Hello, everyone, and welcome. This is Rick J. Krebs, the M&A Cowboy, coming to you from Arizona this time. We're spending a little time here in the sun, and I am way excited about our next guest. Our guest today is a gentleman named Paul Hickey. Welcome, Paul.
Thank you. It's good to be here.
And it's good to have you. So before we get started, what I'd like to do is I like to hear a little bit about you, a little bit about your background. And I want to hear about your background literally. We're looking at an island here. So tell me about that first, Paul. What is that island?
Well, it's an island that I own most of out in Southeast Asia, off the northern tip of Borneo, Malaysia. It's a little bit of a long story how I ended up with this, so I'll try to keep it short. But I was an investment banker doing deals in China. I was taking small cap Chinese companies public in the U.S., and I was traveling and spending a lot of time there. And I thought, well, it would be nice to get a little private island, put a couple villas, and then send my Chinese clients there as a perk of doing business with us. So that's what I did. I acquired this property, and then we ended up not developing it. I stopped doing business in China. And so right now we're looking for developers that want to do nice little green boutique resorts to partner with. If anybody out there is interested, it's an unbelievable piece of property. It's a reef all the way around it. It's untouched, virgin white sand. It's outside of the tsunami belt and typhoon belt. So it's really uniquely positioned and just stunning. I just don't do business over in that part of the world anymore. So we're trying to find some people that want to go out and do something interesting on the island. So,
and for the listeners, you're missing out because this island is beautiful. I'm ready to just grab my snorkel gear and get a plane ticket and go out there because I'm looking at the reef. It's just great snorkeling, and good for you. What a neat story.
This is a particular island where literally any part of the island, you can just walk from the beach right into the water with your snorkel and mask, and the reef is just right there.
Wow.
So if you want to get a group of your clients together and do a camping trip, you're welcome to head out and do a little camping snorkeling,
There we go. It's primitive, Gilligan's Island style.
It's totally, yeah.
Love it. So tell us, Paul, how did you get started with what you do? And before we do, let me give a little background. So Paul does IPOs, so small cap IPOs. And I'm not in that space very much, but we have clients once in a while that want to take their business and grow it and make it public. And so Paul does that. And so that's why I've invited him on the show today. So how did you get started with what you do, Paul?
Well, I started a technology company back in the 90s in Provo, Utah called QCOM, and we created some proprietary hardware and software for the prepaid calling card industry. I don't know, you probably remember that. A lot of people listening to this program may not even know what that is. Prepaid calling cards and prepaid wireless and mobile is still pretty dominant in most of the world, especially the developing world. But so we built this little machine that looked like a credit card terminal, and you put it into 7-Elevens, and somebody would walk in and ask for a prepaid calling card, and our machine would print one out on demand. And it did really well. We ended up placing that in thousands of retail stores around the country and grew like crazy and did our own IPO. I took the company all the way from startup as a CEO and controlling shareholder all the way through an IPO, ringing the opening bell at the American Stock Exchange. That was an experience and a highlight. And while I was doing the IPO, I was sitting back watching how much the investment bankers were making and how much harder I was working. And I thought, I think I need to do that someday. And so after we did our IPO, we actually got acquired by a much, much larger company and taken private. A couple of years later by a Mexican telecom company that wanted our technology for Latin America. We had started to license the technology all over the world to Canada and Australia and France and all over the place. And so they saw that it was a good opportunity for Latin America. So anyway, after that, I actually got hired to be the CEO of a Chinese company and moved to Shanghai. Was planning to stay there for 3 years, but this leads into what I'm doing now.
Yeah.
I ended up only staying a year, and I left and co-founded an investment bank with a partner of mine, Greg Freihofner, who at the time was living and working in New York, and he had come out of MBA school, went right to work on Wall Street, and had been there 20 years.
Hmm.
And so Greg, when I was in China, I was calling Greg saying, Greg, are you seeing these small cap Chinese companies going public in the US? They're really high quality deals. And I think I know more about investment banking than a lot of the guys doing these deals over here. So we started this boutique firm focused on small cap. And when I say small cap, I'm talking about companies that have a value of about 100 million to $1 billion in that range. That was our focus.
Okay.
Um,
Small cap, right?
yep, small cap. Yeah.
Wow. I work in a space where we're, 10, 20 million, and to think of 100 million as being small cap, but that is. Wow.
Yeah. That's the way Wall Street defines them. So um, there's some people call small cap companies now companies at 300 million to 2 billion. When I was doing investment banking deals, it was 100 million to a billion.
Mhm.
Mid caps are a billion to 10 billion. Large caps are 10 billion to basically 100 billion, and mega caps are 100 billion and above, essentially, somewhere in that range, and so that's how I got into the business, is taking my own company public and
Mhm.
then starting this investment bank. And then we sold the investment bank in 2015. And since then, I've helped set up a couple of hedge funds. I've done some advisory work. I got involved in raising money for a semiconductor Bitcoin ASIC mining chip and semiconductor software technology, low power solution company called Granite Mountain Technology, brilliant company. And then recently, what I did is I helped raise and advise an AI startup company in Salt Lake City that needed to raise a couple $1 million. So I helped them as an advisor in that project. And while I was talking, this kind of leads to the book and our topic, by the way.
Yeah.
Sorry, I'm just going to keep rolling
Go on.
here.
No, this is very interesting. Keep going.
Yeah. And so what happened is I was talking to the venture capitalists that were interested in investing in this AI startup company. And the AI
Well,
startup
one
company.
sec. Well, one sec, Paul. So we're talking using a lot of terms here, and some of the listeners may not understand them. So tell us,
Okay.
what's a venture capitalist, and then
Okay.
continue.
Okay. Thank you very much.
Mhm.
I appreciate it. So a venture capitalist is it's a company, a fund that gets money from limited partners. It could be an individual or
Okay.
another fund, and then they go out and they invest the money. And venture capital funds have different themes and mandates. So some
Mm.
venture capital funds are raising money and telling their investors, we're only going to invest in software companies. And other venture capital funds may raise money and say, we're only investing in organic food companies and the food chain supply technology companies. And so they can be all different themes. And so these venture capital companies also are different sizes. So some may only invest $500,000 to $1 million in early stage companies,
Mhm.
like they call them seed rounds. And then the pre-seed round is friends and family, 100,000, 50,000, a couple 100,000, right?
Yeah.
And then the A round, venture capital, there are funds that do A rounds, which is they'll invest, 5 to 10 or 20 million is an A round. And then a B round is like 10 to 50 million. And then a C round is 50 million to a couple 100 million. And there are different funds focus on different rounds of funding, and different places where the companies are at as they're growing. So
Gotcha.
that's the venture capital world. And Rick, I'm glad you brought that up. A lot of entrepreneurs out there listening who are, growing their business, maybe thinking of selling it. I am surprised at how many of them are afraid of venture capitalists and
Yeah.
and raising money from venture capitalists. They
Mhm.
think, in fact, a lot of companies have come to us to go public because they want to raise money that way because they didn't want to raise it from venture capitalists. And
Huh.
I got to tell you, a lot of those fears are unfounded.
Hmm.
Think that venture capitalists are vulture capitalists, that they just want to invest and then ultimately take over the company and take control. That is the last thing venture capitalists want. I'll tell you, the dream investment of your typical venture capitalist is to write a check and then not even hear from you for 5 years until you sell the company. That's what they all want. They just want you to
Gotcha.
take the money, build it, sell it for a lot of money, and make them a lot of money on their investment. They don't want to be in there running your company and interfering and having to do work. That's not what they want to do. Now, they get involved and do that when they invest in a company that's not working out because they're trying to save their investment, right? And so the thing I would say to your group of entrepreneurs listening to this is be a little more open-minded and at least try and get in front of some venture capitalists and see what that experience is like. I think you're going to find that they're way more supportive than you think, and that maybe what's in your mind. And, are they easy to work with? Yeah, if you know what they want. If you're brand new to working with venture capitalists, it's gonna seem like a lot of work, but that's part of kind of growing up. As an entrepreneur, is if you can raise a round of money from a venture capitalist, then you're on the right path of doing big things, I think. So
Yeah, you know what? That's interesting because I work with private equity, and private equity invest, but they buy the businesses, right? They buy them usually entirely. Sometimes they'll do a minority interest, but most of them are buying the business. Venture capitalists are investing in the business.
Right.
And what did you say? Pre-seed, seed, A, B, C. So there's a lot of different levels at which they can invest.
Right.
And that's interesting because there is kind of a bad connotation. I think there's a few bad ones out there that have given the rest of them a bad reputation, unfortunately. But they're necessary and they're helpful to these business owners that are looking to take their companies public. Yeah, that's very interesting. Thank you.
Yeah. I know once they make a decision and write a check and they're investing, they're on your side. They're trying to do whatever they can to support you and help you be successful because that's how they make their money.
Yeah.
Yeah.
Interesting.
So, yeah.
All right. So got a couple of questions. So what is it? Oh, we covered a small cap IPO. So you're writing a book. Paul, tell us about this book.
Yeah, I wrote this book and listeners.
Oh, it's done. There we go.
Oh yeah. Let's see. Wow. Okay, there we go.
IPO versus
VC.
Right.
And I've got a bull and a fox on the front there. And this book was actually inspired by the story I was just telling you about helping this AI startup in Salt Lake raise money a couple of years ago. I was talking to venture capitalists and I was saying, how many portfolio companies, those are the companies they've invested in, are getting ready for an IPO? And I asked that question to probably 5 or 6 different venture capitalists in the Salt Lake City area that I was working with. And every single one of them said the same thing. Oh, I don't have any companies in my portfolio getting ready for an IPO. And then I would say, well, do you have any companies doing 50 or $100 million in revenue? And they said, yes. And I said, oh, well, they're big. They're big enough for a small cap IPO. They could probably get a valuation of, $200, $300, $400, $500 million and probably raise $50 or $100 million and become public. And the response I got from every single one of them was really surprising. It was almost like I started speaking Chinese to them. They're like, wow. A small IPO? I didn't know you could go public that soon and that early. Isn't it too expensive? And that was their common also response. It's too expensive to be public as a $200 or $300 million company. And then what I would do, Rick, is I'd say, do you know how expensive it is to stay private? Do you know what the opportunity cost is? And that's what got their attention. They're like, what do you mean? And so this is why I wrote the book. And I titled it IPO versus VC. I'm speaking to the entrepreneurs out there who also think it's too expensive to go public when you're $100, $200 million company. And I'm speaking to the VCs to go, hey guys, there's another option here, because a lot of VCs complain about liquidity, meaning they've invested in a company and they're waiting for them to either go public or to be acquired so that they can get a return on their investment, right?
Yeah.
And it's called a liquidity event. And a lot of venture capitalists have to wait, generally at least 5 years, but a lot of times it's 10 years or longer. And they're waiting too long. They could get liquidity if they get these companies out the door in a small cap market. So anyway,
Gotcha.
that's the reason I wrote this book, which, by the way, hit #1 bestseller on Amazon in 2 different categories, venture capital and public finance. So,
Interesting. And listeners can find it on Amazon, right?
yeah,
Now?
you just go to Amazon
Okay.
and punch in IPO versus VC, and there's a paperback or an ebook version. Kindle version.
IPO versus VC
That's
from
it.
Paul Hickey.
That's it. Yep.
Yeah. Gotcha. Well, that's really cool, Paul. So, with these small caps lost favor a little bit. Why do you think they lost favor?
Yeah, when I was doing investment banking back in 2005 to 2015, a couple things happened. And they were in big favor back then. There was maybe 400 or 500 small cap IPOs a year back then. Now there's a couple hundred. I think they're going to come back. We'll talk about that in a minute. But the reason is around 2011, there was about $20 billion of venture capital money invested every year. By 2021, that was over 200 billion. 10x the amount of venture capital money to invest in these companies, 10x in literally 10 years. And so when you have that much money, you can't deploy it as a venture capital company or firm by writing $500,000 checks and $1 million checks. You got to start writing bigger checks.
Yeah.
And that never existed back in 2005. You weren't getting venture capitalists writing $50 and $100 million checks, but now you do. And so if you're a company that's got let's say a valuation of $300 million and you want to raise 50 million bucks, well, you could do that in a small cap IPO. It's going to take you about a year. It's a lot of work. But if you want to raise it from venture capitalist and you've already raised an A, B round, and so you've got all your documents and everything, you might be able to do that in 3 or 4 months if you've got interested investors raising it from venture capital. So it's a lot faster when you're private than to do an IPO. So that's why a lot of companies that's why IPOs, small cap IPOs kind of fell out of favor. One of the main reasons is because it was just easier to raise 50 or 100 million bucks from venture capitalists when that didn't exist in the 2000s, right? It was very rare. So, that's one of the reasons. And, SOX, which Sarbanes-Oxley Act, this was an act passed by Congress to require more reporting to public companies, so there was less chance of fraud. That increased the cost of going public and remaining public. So that kind of had a little dampening effect also.
So if I'm a business owner, I'm looking to do a small cap IPO. What am I looking at, just ballpark on cost to do it?
Yeah, you're going to spend $1 to $2 million. Now, that sounds like a lot to a small company that's maybe doing 50 or $100 million in revenue. But when you think about the fact that you're going to be able to raise $50 million at a good valuation and use that money to grow, because once you're public as a small cap company, it's also going to cost about $1 to $2 million in legal fees and filing fees, and you're being on listing on NASDAQ and your D&O insurance and your board and your investor relations. Those are all new expenses. And if you manage them really well, you can probably do it for about $1 million a year. And so, but it can cost you more depending on how big your company is and what you want to do in terms of all the things that require expenses. But what most people don't understand, and this is the big message to the founders and VCs, is how expensive it is not to be public.
So I love that. Hold on one second. So a lot of people are asking, well, what's the cost? Right? But that's the wrong question.
It is.
What is lost by not doing it? It's not the cost, it's what is lost. And as I work with these business owners, I find the difference between people that are just super successful and those that are just limp along are the questions that they ask. And the limp alongs are always asking, well, how much does it cost? No. What value does it bring, or what do I lose by not doing it? I love that notion. So go ahead. I interrupted you, but I just think that's such an important point to talk about.
It is. And it's a major thesis, Rick, of the book. And even venture capitalists, who were very smart people, are not analyzing this the right way. They're not looking at the opportunity costs. And I kind of hammer away at that in the book multiple times. But let me just give you an example of one of the things you give up by not being public. And one of the things you gain if you do go public is a higher valuation. It's called a liquidity premium. And so the idea is if you're an investor and you have the choice to invest in two companies, they're the same size, they're in the same industry, everything's the same, one's private and one's public. You make an investment in the private company, you may not be able to get any liquidity or return on your investment for 5 years or 10 years.
Yeah.
But you invest in the public company, you can invest today and sell your stock tomorrow. So you have that liquidity, and people are willing to pay a premium for liquidity. So that's one of the reasons. There's several other reasons why public companies have a higher valuation than their private counterparts. But on average, it's about 50% higher. And so think about that for a minute. If you're a private company with a valuation of 300 million and you're going to raise, $50 million, or let's just call it $100 million, now you're diluting yourself based on a $300 million valuation versus if you're a public company, chances are your valuation is going to be $400 or $500 million because of the liquidity premium. So by staying private, it's costing you $100 to $200 million in value in your company.
Wow.
And so,
What? Yeah,
right.
I see that. People, it's counterintuitive, right? They think the bigger you are, the less investors there are. And that's the opposite. So when you have a publicly traded companies, there's a lot bigger pool of investors and it's pushing that price up. They think, no, I'm bigger, so there'll be less money. Not the case with Wall Street. The bigger you are, the more money there is.
It's literally the opposite. There's an inverse pyramid.
Yep, exactly.
And the smaller you are, the less money there is for you. And the bigger you are, the more money there is for you, right? And that's the way it works. And, the small cap public market is $4 trillion. It has $4 trillion worth of value. And that's $4 trillion of liquid money. And so it's not a small market to be playing in. So there's plenty of money for these small cap companies. So, this is the whole idea of when you do your analysis as a private company, yes, it's going to cost you $1 to $2 million to go public, and it costs you $100 to $200 million to stay private, right? So,
wow.
Let's look at all those factors, and there's a couple more that are key ones to hit on. In fact, so I have 9 benefits that you get by being a public company versus staying as a private company.
9.
Each one of those are benefits that are really helpful in growing your business. And each one of them are an opportunity cost if you don't have them as a private company, right?
Yes.
So, we can talk about those, but, I would say just before we jump into that, I would say for your listeners out there, how big do you need to be before you start considering that? There's a famous venture capitalist in Silicon Valley right now. His name's Keith Rabois, and he is a managing partner at the Founders Fund. That is Peter Thiel's fund. It's one of the most successful funds. Peter Thiel is one of the smartest guys on the planet. He was the first institutional investor in Facebook, and he's just done extremely well. And Keith is one of the guys out there in the venture capital community in Silicon Valley saying, you need to go public as soon as possible. And he's not one of these VCs who think you need to be a multi-billion-dollar company before you go an IPO. He actually says, if you've got $50 million in revenue, you should start looking at doing an IPO, a small cap IPO. And the reason he says that is because you get more value. He likes the transparency it requires. It requires, responsibility and reporting and some structure and discipline that you don't have to have as a private company. So yeah, it's a little more work, but that's one of the reasons you get a higher valuation and you attract more money and investors because of all those things. And so he's helping the VC community wake up to this, and again, hopefully my book helps to some extent.
There you go. Move the needle, right? So you're saying probably 50 million in sales. When you're 50 million in sales, that's time to start looking at an IPO and preparing for it.
Yep, you can start. And here's the other factor. This is really important for small cap companies in terms of determining whether you're a candidate to start really considering. You need to have very predictable growth for at least 2 years from the time you do your IPO. Small cap companies are all about growth. That's why the public invests in small cap companies. It's because they have a lot of growth potential. Actually, I have a question for you and your audience here to answer. out of these companies, which one of them was a small cap company when they did their IPO? Apple, Microsoft, Amazon, Tesla, or PayPal?
Wow. Well, I'm going to say it's the one that I don't think it is, and I'm going to say Amazon or Microsoft, but
It's a trick question. All of them were
what?
small cap companies when they went public.
No way. Really?
Yes. Yes. Everybody's forgotten that. They're the largest
Wow.
companies in the world, and
Mhm.
they started out as Amazon had a $400 million market cap when they went public.
Wow.
Mi-
We'd only
Mi-
invested.
yeah, right. Microsoft had 700 million. And so these companies were all small cap companies. And, again, the VC community has forgotten about that. This is where great companies are born, is in the small cap market. You don't have to be a multi-billion-dollar company to do an IPO. So anyways, the venture capital world, I hope, is waking up. But you need to have good growth as a small cap company. So if your company if you're doing 100 million in revenue and your revenue and sales are stalling, you're not a good company to be a public company. You'll get crushed as a small cap public company. So really predictable. And a lot of entrepreneurs say, well, what kind of growth rate? Well, it depends on the industry you're in and the segment, and it depends on the comparables. So you want to look at the public companies that are your competitors and in your sector and look at their growth rates. And if you're at their growth rate or above, then you're probably a good candidate for going public. But, general rule of thumb, you got to be growing 20, 30+% a year at least if you're going to get anybody's attention as a small cap public company. So
Gotcha.
at least 50 million in revenue, 100 million is probably better. And you got to feel very confident about your growth for at least 2 years after you're public. Now, once you get your 50, 100, $200 million in the IPO, you can use that to really ramp up your growth and even accelerate it, which is one of the main reasons you do it, right?
Hmm. Interesting. This is a world that I'm not in, but it's fascinating to me. And so as the listeners have questions, how can they contact you, Paul? How do they get answers to their questions?
Yeah, I have a website. And by the way, I want to circle back to, um, what I do now. You introduced me. So I am not an investment banker any longer. I don't actually raise the money and do the IPOs. I do what's called IPO prep work. So if you decide you want to go public, there's a lot you need to do for a year to get ready. And one of the things I do is I connect you with the best investment bank, depending on your size, industry. There's different small cap investment banks that I've worked with over the years. I'll connect you with the right auditing firm based on your size and your industry. The right law firm. You got to make sure you get the right lawyers and auditors and professionals on board, helping put together an independent board that you're going to need to have as a public company. And so there's a number of things that I do as an advisor to help them do this the right way and to make sure that it's successful. And then in addition to that, I am work with a wealth management company, Legacy Wealth Management. And so obviously, once you do the IPO, most entrepreneurs are now sitting on 100, 200, 300, $500 million worth of liquid stock. This is another benefit for going public is you get what I call a flexible exit. So if you're building your business and you sell it, you're done. You might have an earnout, but it's pretty much done. And if as that business grows, you're not going to participate typically in the future growth. When you do an IPO, you can sell a little at the IPO. You want to take some money off the table and sell 5 or 10% of your position. Let's say your position is worth $200 million now after you go public.
Mhm.
It's not unusual to take $20 million off the table and diversify. Wall Street understands the importance of that. And then maybe this thing goes and doubles over the next 2 or 3 years, and now it's worth $400 million. It's okay to take another 10% or whatever your needs are to diversify. So you have the options. You could actually set up a selling plan to sell like 1% of your stock every month as a way to diversify and to take some money off the table. So there's lots of flexibility in exiting. You can have a big chunk you sell at IPO. You can sell nothing. You have ultimate flexibility, which is another real key benefit, not only for the founders, but also for the investors, the venture capitalists, because they can get liquidity, which they want, or they can hang on if they really think this is the next Amazon. They can hang on to their investment and maybe 10x it again, but have the option to sell anytime they want, right? And so that's another big benefit, is just liquidity that you get. Everybody benefits from liquidity. And I'll tell you, one of the other benefits, Rick, here is as a public company versus private. And this is a hard one to put a number on. Valuation premium, we can put a number on that. But recruiting talent, if you're a growing company, probably the most important thing you do as an owner, founder / CEO is recruit the best talent you can get your hands on, because companies are just people. And especially if you're growing really fast, you need the best people you can get your hands on. Now, if you have two companies that are trying to recruit the same person, and one of them is offering stock options in a private company that sometime in the future and years may be worth something, or you're a public company that has liquid stock that is able to be sold literally as soon as they earn it, who's going to win in that contest for that person? It's the public company. Public company stock options are really valued by, high-level talented people. And, obviously, if you go and get some stock options at a private company and they go public, it can be worth a lot and you can do really well, and a lot of people have. But if you're competing for talent and you're a public company and have that option to offer stock options that are with a public company and have liquidity versus a private company, you win as a public company, assuming all things also are equal, right? So it's another big benefit, and another huge cost. As a private company, you're losing people that you don't even know you're losing because they're not even coming to you, right? They're going to the public companies first, right? So another big reason to go public.
Yeah, interesting. Well, this has been really great today, Paul. Thank you for sharing. And I'm going to tell the listeners about the book. Where can they find you, and how do they get in touch with you? Questions? Yeah,
so they can go to my website, which is sixsummits.co, and it's spelled out SIXSUMMITS, sixsummits.co. That's my IPO prep. And on there's a place to reach out and get a hold of me on the website, and they can email me, and then I'll be happy to talk to them about the possibilities of them doing a small cap IPO.
All right. Well, sounds good. There you have it. Thank you to the listeners, and everyone, have a great day.
Thanks for having me on, Rick.
Thank you for attending our podcast. We invite you to join us for future episodes of M&A, Murders and Accusations, the good, the bad, and the ugly of selling your business. You can also visit us at www.bsalesgroup.com or email Rick directly at rick@bsalesgroup.com.